Hello, excuse me. Hello, and welcome back to a demo video. In this video, I want to cover exercise 15-10. Put that right there. EX 15-10. And it is on page in your textbook. It is on page 678. Okay. So, excuse me. What this exercise is looking to do is it's looking for us to handle long-term notes payable, right? So they tell us that the drilling company borrowed $300,000 on January 1st, 2017 by issuing a $300,000 8% mortgage notes payable. The terms call for annual installment payments of $40,000 on December 31st. So what we need to do is we need to prepare the journal entries to record the mortgage loan and the first two installment payments. We also need to indicate the amount of the mortgage notes payable to be reported as current liability and as a long-term liability at December 31st, 2017. Okay? So, what we're going to do first, and if you notice here, I went ahead and created a little chart. Now, this chart should be very, very familiar. Why? Because it is the long-term notes payable illustration that we did in the lecture videos. Cash payment, interest expense, reduction of principal, principal balance. Okay? So, what we're going to do is just go ahead and plug in the information and calculate everything. Okay? So, we know as of January 1, right? Or, I'm sorry. Yeah. Jan 1, 2017. We borrowed $300,000. So the principal balance on this note is $300,000. Okay? So we need to prepare journal entries of the installment notes for the first or the first two installment payments. Okay? So we know that we have to make annual installment payments. Okay? So on 12/31/2017, we need to make a payment of, or at least book our payment of $400,000. Okay? We need to figure out what is our interest. Well, that's easy, right? The interest expense is going to be the principal balance of $300,000 times 0.08. We end up with $24,000. So what is the reduction of the principal balance? Well, that's easy. The cash payment minus the interest expense of this installment payment gives us $16,000. Okay? What's the running balance then, or what's the principal balance after this payment? Well, that's easy. It's going to be $300,000 minus the reduction of principal, which is $16,000. We have a balance of $284,000. Okay? Remember, we have to do the first two journal entries. Okay? So that means I need to go out another year, right? And we'll say 12/31/2018. Well, that's easy. What's the cash payment? Well, the installment payment's $40,000. It's never going to change. Okay? What's the interest expense dealing with this, just this installment payment? Well, that's easy. What's the running balance of the principal amount? Well, it's $284,000 times my 8% gives me $22,720. Cool. What's the reduction in principal? Well, that's easy. I take my cash payment for this second installment minus the interest portion of that. I get $17,280. Okay. So at the end of year 2, how much am I going to, or what's my principal balance going to be? Well, that's easy. I'm going to take my $284,000 principal balance minus the reduction in principal from this payment, this second payment. I get $266,700. Okay. Now, so we did our calculations. Now all we have to do is just go journal it. Okay. Well, that's easy. All right. So the first journal entry we need to make is prepare a journal entry to record the mortgage loan and the first 2 installment payments. Okay. So this is going to be actually part A. Okay. And the first journal entry we need to make is show that we got cash and we signed a mortgage payable. So I'm going to debit cash for $300,000 and I'm going to debit mortgage payable for the same amount. Okay. Now, the next thing I need to do is journal the first interest payment. Okay. And this is as of 12/31/2017. Well, guess what? I already have that information right here. I already calculated it, right? So, what's the first thing I'm doing? Well, I need to recognize interest expense of how much? Well, right here, it says it's $24,000. Okay? And again, how did I get that? Well, I just took the principal balance, $300,000, times the interest rate of 0.08. Okay? The next thing I need to debit is my mortgage payable, because my payable amount of $300,000 is going down, right? I owe $16,000 less. So, what am I going to do? Well, I'm going to debit mortgage payable for the $16,000. Okay, and I see that right here. And then finally, I'm going to go ahead and credit cash, because obviously I'm paying cash. How much cash am I paying? Well, I already know the installment payment's $40,000. Okay. So that's the first installment payment. Now I need to make the second installment payment, right? 12/31/2018. It's going to be the same journal entry, right? Interest expense, mortgage payable, and I'm obviously going to credit cash. So, if I were you, I would put on a note card or in my notes, hey, here's the journal entry whenever I need to make an installment payment. It's never going to change, meaning what I debit, what I credit is not going to change as long as I'm making an installment payment. The only the only thing that is going to change are the numbers, and that's okay. That's easy, all right? So, we go to the second installment. Oh man, I messed this all up. Bear with me, I'm so sorry. I don't know what in the world I did. Okay, mortgage payable. And I'm going to credit cash. Okay, so I got the journal entry. Now I need to get the amounts, right? I have them right here, right? What's my interest expense? Well, my interest expense is $22,720. The reduction in principal, how much is that? Well, it's $17,280. And the interest payment, the cash payment is going to be $40,000. Okay. Now, If you didn't do this, if you didn't do this chart, how exactly would you calculate the interest expense? Well, that's easy. That's really easy for us to do. Okay, let's think about that. Right? We started off with a principal balance of $300,000. Right? Back in 2017, we deducted $16,000. That gives us our $284,000, right, that we have right here in our chart. But I could just calculate that right there. Then I need to multiply by my 0.8% or 0.08. That's how I get the interest, right? Same thing with the mortgage payable, right? How do I calculate that mortgage payable? Well, that's easy. To calculate the decrease in the mortgage, I just take my payment, $40,000, minus the interest of $22,720. I end up with the $17,280. Okay. Again, what I did here, how I calculated these, the logic's the same. Okay. The logic that I used to create this chart is identical to the same numbers that I typed in here, or the same calculation that we ended up with here. Okay. Now, part B wants us to determine, part B wants us to determine, indicate the amount of mortgage note payable to be reported as a current liability and as a long-term liability at December 31st, 2017. Okay? That is so easy for us. And why is it easy? Well, it's easy because we already have the numbers, right? We already have the numbers in our chart, okay? So at the end of 2017, how much am I going to have to pay to reduce the principal of this note? Well, $17,280, okay? So let me show you how we should calculate that here, right? So if I'm looking at part B, it wants to know the current portion. Right? And that current portion is going to be the 17,280, right? How did I get that? How did I get that? Well, obviously, I just went to the chart and looked at it. As of December 31st, 2017, well, the next payment that I have to make that year is the $17,280, and then the $266,720 is the long-term portion. So how do I figure that out? Well, that's easy, right? If we didn't do this chart, how would we calculate that? Well, that's easy, okay? We would take the payment that we're going to have to make next year, right? In December of 2018, I'm going to have to make a payment, cash payment of $40,000. Okay? We know that. Then I need to subtract out the interest portion. Well, what's the interest portion of that? Well, I know that the balance after I make my first installment payment is $284,000. $284,000 times the interest on that second payment, 0.08. I end up with the $17,280. Okay? Now, the long-term portion. That's going to end up being the $266,720, right? That's this portion. How did I get that? Well, I did my chart. I already went through each of my calculations. But if I just want to do it, if I just want to calculate it without doing the chart, can I do that? Of course I can. What's the calculation? Well, it's easy, right? Think about it. I need to take my beginning balance, $300,000. That's how much I originally borrowed. Then in 2017, I made a payment of 40 grand. 16,000 of that went to the principal, so I need to subtract that out. Oh, sorry about that. Man, this thing's touchy. $16,000. Then I need to subtract out the amount that I'm going to pay in 2018, right? Because that amount in 2018 is going to be the current portion, which I already have on the screen, which is then going to be 17. So I need to subtract out the 17,280. That's how I ended up with the 266,720. Okay. I want to run through the logic of how to calculate this. But again, if you just do the chart, it's so simple. It makes it a lot easier because you could just, in one fell swoop, you're making the calculations up. Here's how much I have outstanding at the end of the year, $284,000. Okay. This total outstanding at the end of the year, what's my total liability just for this mortgage? Well, it's $284,000. I need to break it apart. I need to say that $17,280 of this total $284,000 is going to be due in 2018. The remainder, $266,720, is going to be long term because I'm going to pay that as the years progress, right? After 1 year. Okay. So that is how you calculate mortgage payables or mortgage notes payable, how you calculate the interest expense, and how you report that. Okay. When excuse me, when we come back, I want to go through an example of amortizing discounts, right, or amortizing premiums. Okay, so please tune back in for that one.